All right, everybody. Welcome to the webinar today. My name is Nate. It's a pleasure to be here with you. I enjoy doing these things for our clients and others that are interested in learning more. Today's webinar is going to be based on a question that we get all the time. And I assume if you're on this call, then you probably have had this question come to your mind before, as I think it probably hits almost everybody's mind. And by the way, this webinar is based more for those who are actually already doing the becoming a maker concept. So if you, I mean, it'll help you if you're on the fence, but the whole, the basis around this concept is, hey, I already own a banking policy. I'm using it, but I have this question and that's come up. And that's whenever I have money in my policy and I have money in cash. And I want to know which one of these am I going to use to pay for something. And it becomes a real issue. People are curious. Hey, Nate, uh, and most of the time it's asked in a very innocent way. So they come to me and they say, Nate, we're going on vacation in a month or two. It's going to cost us $5,000 to go on vacation. We've got the money in our policy to do that, and we've got money sitting in a bank account to do that. Nate, which one should I use? And it's asked very innocently, based on just hey, really curious, Nate, for your advice on this. I would say, I would also say that sometimes it's not quite as innocent. Sometimes people are sitting there like, why would I use my policy and pay interest to somebody when I can just pay cash, not pay anybody any interest? And maybe it's a bit more on the attacking side. So hopefully you're over that and you understand why it can make sense if you already own a policy. But we still get it sometimes from other people who are just kind of confused. And so we're going to answer this question today as best as I can of when it makes sense to do either one. But there is going to be a curveball here. And I hope you enjoy this curveball. But I also want to mention, and this really does lay the whole foundation of the webinar. So by the way, if I backtrack for 1 second, I'm going to lay the foundation for this question, how I see it, how I think you should probably see it. And then we're going to dive into some numbers and prove it to you of which one is better and how to situate your money in order to make the most profit. So that's the scope of this webinar. I don't think it's going to be more than 30 minutes long. It's not going to be a super long webinar necessarily because I think it's going to be pretty simple to understand which one's better. And it's all based on this question of what should I use? Should I use my policy or should I use cash? And as I said, there's a bit of a curveball in this answer. And that's because I think the question is a little bit misguided or is coming from a misguided place to some degree. See, the problem is not actually which option should I use. The actual problem in this scenario of which one to spend the money, the problem is that there is money over here on this side of the equation. That's actually the problem. So whenever you practice infinite banking and you come to me and you say, hey, Nate, should I use my policy to fund this or should I just pay cash? The problem is not which one should you use. The problem is actually the fact that you have cash sitting in Wells Fargo or wherever you bank, sitting in somebody else's bank that is doing nothing for you, and you're knowingly allowing that bank to take those deposits you've made with them and lend them out to other people at interest and then keep all the interest that they earn on your money. That's the problem. The problem is that you're knowingly doing that now that you're a banker in the infinite banking world. And you're telling me, Nate, you know what? I've got money in cash and the policy. Which one should I use? Well, obviously we want to use policy money. The problem is actually that there's this money over here that hasn't made it into your own bank. That's actually the problem at hand. And you see, sometimes when this comes up, we get a few other questions, but it's pretty simple when you really understand it. If you owned a brick and mortar bank, you decide it's a great business model, I'm going to go open a bank. What are the chances that you decide to open up accounts at other banks down the street and do your business there? Obviously, doesn't make any sense. You wouldn't do it. But what surprises me is that for quite often, what occurs is that people who are in the infinite banking world who have policies, they still are knowingly giving money to a bank in the form of deposits, and using the letting the banks use the money and profit from it when they actually have already tasted and seen how to escape from that. That's the problem. The problem is that the banks are a parasite. They're just sucking money from their depositors and from their borrowers to profit. They can't survive on their own. They can only survive if we put money there. And then they take that money and they profit from it, and they don't give it back to us. They're a parasite, um, as far as I'm concerned, especially once you know how to use the policy to make to escape from that. So this is the problem at hand. And sometimes I'll talk to people, and I'm surprised that they have this money on the sidelines that they won't get in. And there's a lot of times there's some sort of maybe a fear involved, where we don't actually want to put money in the policy, or there's something that we're just not certain of, or a paradigm hasn't shifted in our mind to see our policy as truly our new bank. This is where my money's going. This is where I'm pulling from. And I'm going to keep as little money as I can over here inside of a typical bank at Wells Fargo or something like that. And there's some sort of trepidation or some sort of fear. There's some sort of hindrance that keeps people from making that paradigm shift. So I'm just going to encourage you today to make this shift, to see the policy as the bank. And I think it's actually very hard to practice this banking concept very well if you are afraid or discouraged or have some trepidation to putting money into a policy. I'm always a bit surprised whenever I hear people, it's like begrudgingly putting money into the policy, like the stupid premiums due and there's loan repayments coming up and so forth. And they see it as if the policy is taking money away from them. And that the reason that paradigm hasn't shifted is because they still see anything that leaves their checking account as a subtraction to their wealth. You've really got to get to the point where you're excited. You look forward to putting money into your policy. And if you're not there, if you still don't like putting money in, you probably just need to change your paradigm by mainly just seeing what it's doing. And so that's really where we're going to go dive in today, starting right now. And I want to show you that anytime you can move money out of Wells Fargo and put it into a policy, and then use that policy to, let's just say, we'll use that vacation idea. You go on vacation, you're going to make more money than if you just had the money at Wells Fargo and paid for the vacation. So here's what I want to prove to you today. It's always best to use a policy to pay for something, but it comes with a caveat that assumes that you've already taken your cash and rolled it into a policy first. If you haven't, and you're still sitting on a lot of cash outside the policy, the question is not, which one should I use? The question is, how can I put that money into my own bank and then use it, as opposed to keeping it in Wells Fargo as a deposit in their checking account or their savings account? Does that make sense? I hope it does. I hope it does. So that's what I want to prove to you today, is that it always makes sense to use a policy as long as we have moved the money in, or we're planning on moving money in. If you come to me and you say, Nate, I don't have any interest in moving money into a policy, I've got all this cash thing on the sidelines, I don't want to do banking, then you're right. What's the point? You're not practicing infinite banking. You just own a life insurance policy and you're banking the old way. Okay, sure, pay cash for it. But if you want to practice infinite banking, we will want to move the money into the policy. So this is what, let's go ahead and dive in. Let me go pull this up and I'll show you exactly what I mean by this. And there's a lot of numbers on this page. I'm going to show you exactly what's going on with this comparison. And the first thing I'm going to do is I want to draw a line right here in the sand. And I want you to know that there's really two sides of this that we're comparing. There's two sides of this. And this is that same concept. This is somebody that has already started a policy. They're already practicing infinite banking. They come to me, let's say innocently, and they say, hey, Nate, We go on vacations. The cost of the vacation is around $5,000. We go on them about once every other year, something like that. We save up and we go on them once every other year. And we could have done it every year. We could do it every other year or so forth. We just chose to do it, assume that we're going to do it every other year. Question is, hey, which one should I be using to pay for these vacations? Should I be using my policy to pay for them? Or should I be using the cash I've saved up in a bank? And remember, my answer to that is, well, the best thing to do, the most profitable thing to do, would be to try and figure out a way to get the money out of Wells Fargo's checking account and into your policy, and then use your policy to fund the vacation. And that's really what I'm here to prove with real numbers inside this policy, is that it's always best to roll money into a policy first and then use it, as opposed to just having a policy with cash on the side that you're spending. Hope that makes sense. If it doesn't, I'll try to make it clear as we go through. So on this left side of the line, we have a policy and a savings account, and we're going to combine those two to go on vacation to some degree. On the right side, we'll have moved the money into the policy. Let me show you how we do that. We're going to assume that this person has had a policy for a few years. We're somewhere down here in year 5, we're going to say. And this guy on the left side, this is what you come to me at. Here in year 5, you have $37,000 in cash value in your policy, more than enough to go on vacation. But you've been going on these vacations for a while. It's already a part of your budget. You've been saving them up, saving up the money, to go on those vacations. And so you're sitting here in year 5. You also have $5,000 in cash sitting at Wells Fargo, Bank of America, just like you've always had to go on this vacation. It's coming due. And so you say, Nate, I've got this $5,000 in cash. I've also got this $37,000 in cash value. Which one should I use to go on this vacation? Well, remember, what's my answer going to be? The real question is not, hey, which one makes most sense? The real question is, hey, Nate, how can I get this money out of my savings account and into the policy? And will that be more profitable for me? So that's what I'm here to show. So on the left-hand side, what we're going to show happening is we're going to show somebody who doesn't take my advice. Okay, that's what that's going to illustrate here. We're going to show someone who never uses a policy to go on their vacation. And by the way, this doesn't just work for vacations. We could put anything in there, but that's just something that's fairly easy to illustrate. We're going to show someone who doesn't ever go on vacation using policy money. All they do is pay premiums to let money sit in the policy, and then they use cash on the side to fund their vacation. On the right-hand side, we're going to have somebody take my advice. And on the right-hand side, you'll notice something. That in year 6, what we actually show happening here is we took the money out of our savings account and we moved it into a policy. And as you'll see in year 6 on this policy, on this left-hand side, we only put in $4,000. In year 6 on the right-hand side, we put in $9,000. These are the same exact policies, by the way. You'll notice that in year 5, we have $37,666. On the right side, we got $37,666. On the left side, the same exact policy on both sides. The only difference is that the policy on the right-hand side, we moved in the savings that he'd built up in cash. And we did that in this example through the paid up additions rider. So that's the cash rider. We had some room in there in that year that we could fit it in. More on that later. Hold your horses. More on that later. But just know, all we've done is we've taken our $5,000 of cash on this right-hand side, and we've moved it in to the policy one time. And since we don't have cash to go on vacations anymore, sitting in a bank on this right side, don't we have to pull a loan out to go on vacation? Yeah, we have to, right? We have to pull a loan out to go on vacation. So that's what we do. We don't have cash to pay for. We move the cash into the policy. And now we're really practicing infinite bank. That is our bank account. We don't have the money to go on vacation outside the system. So what we do, and you'll see this every other year, we take out $5,000 to go on vacation, and we pay that back over 2 years back into the policy. And so if we took out $5,000 and paid it back over 2 years, if we use the policy and take out a policy loan, we'll have to pay it back with 5% interest. You got it? And so you'll notice we actually put back in a total of $5,280 actually. So we take out 5,000 and we put back in 2,640 over 2 years. So a total of $5,280 we put back into the policy for each vacation we go on, because we know that with the policy we have to pay ourselves back with interest. What we did on the left hand side, remember, he didn't use his policy to go on vacation. He decided not to take my advice. He had cash sitting in an account. He spent it to go on vacation. And then you'll notice he decides to deposit the same amount of money into his savings account that we are putting back into our policy. So he also puts back in 5,280. And then we spend $5,000 again, and we spend $5,000 again. And we do the same exact flow of money on this right-hand side, where we take out $5,000 every other year to go on vacation, and we pay back $2,640 into each account. Does that make sense? So what we're doing here is we have both sides, apples to apples. They each have the same amount of premiums going in every year, same amount of premiums. They each have the same amount of vacation repayments. One guy's just, making a withdrawal from a savings account and putting money back into it. The other guy's taking a policy loan from a life insurance policy and then repaying that loan. But both guys are using the same amount of money in both systems or both strategies. And at the end of, we did 6 vacations. We could have done any number of them. In fact, the number gets better and better. The numbers get better and better for the right-hand side the longer we go. We could have done many more vacations. But just assuming 6 vacations, we just put a stop to it, keep it simple. You'll notice that at the end of that time frame, we have $137,826 in our cash value of this policy. If we go on to the left-hand side, we only have $129,356. Why does the side on the right have more money than the side on the left? It seems pretty obvious. That's not a trick question. The only difference between the two is that this guy wrote one check one time for $5,000, moving money out of his Wells Fargo account into his policy through the paid up additions rider, and then borrowed against that new money $5,000 every other year and repaid it. Now, it's not a full difference. It's not completely apples to apples, because doesn't the guy on the left, doesn't he have money that's built up in his savings account over this time frame as well? The answer would be yes. So to be fair, we just can't compare what this policy is doing to this policy. We have to compare what this policy is doing compared to the other side with both the cash value and the savings account. So if we just pull up a simple calculator here, we can take the 129,356 and add in 6680. And so the total amount of money that the left hand got, this is the guy on the left side who decided he did not want my advice. I'm going to pay cash for all my vacation. I don't want to put the money in the policy. I don't want to pay interest to anybody. I just want to pay cash for my vacation. Okay, go for it. Have fun. Just pay the premiums on the policy. You'll make money. It'll be okay. So he's got 136,036. Well, what does the guy on the right have? 137,826. So 137,826 minus 136,36. That's right almost, isn't that right at $1,800 difference? $1,800 difference right at between the right-hand side and the left-hand side. So we have $1,800. All we did was change where we decided to build up the money to go on this vacation. We've got $1,800 more sitting in our pocket. But notice as well that the death benefit of this policy is pretty significantly higher than on the left side when we didn't do it. It's got $22,000 more in death benefit created on this guy's policy on the right, who took my advice, than what we had, assuming we just kept the money separate. We kept our savings on one side and our cash on the other. We didn't correlate them two. We just paid cash for everything. So what you can see here is that just on a simple little $5,000 vacation, nothing crazy going on. Just only 6 vacations. We could have made the numbers bigger the longer we went down. If we show a lifetime of vacations, the numbers get huge. But all this to say, we have more cash and more death benefit by merging the two. It's always better to move your cash that's sitting in Wells Fargo, that we're knowingly allowing a third-party bank to control those deposits that we have with them, to make a profit for themselves that they will not share with us. It's always better to take money out of the bank and move it into your own banking system, and then use it just as if, just the same way as you'd always live. Because on the left-hand side, remember, if you're paying cash for your vacations, you're going to have to build up money in order to go on those vacations in the future. So if you spend $5,000, you got to build it back up, spend it, build it back up. Isn't that exactly what we're doing on the right-hand side as well? We've just changed where we're doing it. And before I'm about to open this up for questions, so just hold tight. One more thing to note. Inevitably, when I share this, I will get this question. Hey, Nate, what if I don't have room in my paid up edition writer to put this money? What if I don't have room in there? That's what you're showing here happen. What if I'm not in that situation where there's room to fit $5,000 in my paid up edition writer? Great question. But don't get too stuck in a box here. If you are telling me that you are maxing out the policies that you own and you're putting in as much premium as those things will hold, which I suggest you do, and you still have money sitting over here in the savings account, don't you think it probably means it's time to open another policy to start moving that money in to your own system? That would be my answer there too. That normally is just a signal that you don't have the amount of premium that you are able to put into the existing system is just not, it's too low for you to practice this system appropriately. And some of you would say, well, Nate, what if I don't know if I can keep paying premiums on it, or I don't know how to structure it? Well, just talk to me. Just talk to me. You might be missing something. Maybe we can use money from one policy to help fund the other if needed. There's a lot of things we can do. But the key is you want to get to the point where the vast majority of your money is flowing to and from your policy, not to and from your bank account. Now, you will always need a bank account. Don't get me wrong. You can't survive in this world without a checking account. So you're going to need a bank account. We just suggest not having more than about 2 months of operating capital, 2 months of expenses built just in the checking account. If you spend 10 grand a month, try not to have more than $20,000 sitting around in somebody else's bank that you're allowing them to lend out at a profit that they don't give with you. Move it into the policy where the insurance company will lend it out as well and give you back all the profit that is made. That is infinite banking in a nutshell. I hope I proved it to you to some degree here, and I would love to hear your questions and your thoughts on it now. So I am all ears at this point for what questions you guys can have. So go ahead, and I think some people are raising their hands. Just go ahead and type your questions in to the chat bar or the question and answer section. You can chat a question, you can question and answer a question. and I'll get them answered. So as we wrap up, as I mentioned, always know that it's better to use your own policy to fund everything you do in life. That does assume that you actually need to have the money moved into the policy first. I have a question from Susie asking. He says, "So you take your cash and you said put it in a loan, but I think what you actually mean, so you take your cash and you put it into the premium. Then what do you actually use for your vacation money?" Well, you have to use your policy for vacation money. So you would then that's what you're seeing on the right-hand side. You're taking a $5,000 policy loan each year and then repaying that loan over the next 2 years. That's what's going on the right-hand side. On the left-hand side, all you're doing is just taking $5,000 out of your checking account and then putting $2,640 back in to that. That's a great question. Melanie says, what about using that $5K cash to pay back any outstanding loans you took from your policy? Well, that's never a bad idea. But remember, a loan repayment does not add anything new to your policy cash value. So the only way to improve the performance of your policy is to increase premium. And the only premium that can be changed is your paid up additions rider. So if you're already maxing that out, then the only way to increase your system, remember, banking is a system of policies. No one accomplishes it with just one. And so if you wanted to, you'd have to pay more premium in order to change the trajectory of the policy and improve it. So yeah, you could take $5,000 sitting around in cash and pay back a loan. That's a simple transaction as well. That would work just fine too. But just know that it wouldn't actually change the trajectory of the policy. We would prefer money to hit the premium. Oh, we have another question. What if my policy is only a year old and my cash value isn't large enough? I'm not totally sure how to answer that because this was helping decide which one to use. If you're saying that you have an expense that is greater than the cash value you have in your policy, so you're going to need to use cash, once again, my answer would be the problem is actually that there's not enough money in the policy to do it because there's to answer that question, there would apparently be money outside the policy that we're going to spend to do that just wasn't ever rolled into the policy. So I would suggest even in year one, if we can fit it in, roll it in, or maybe we'll need to start a new policy. Exactly. Tammy says, could you just pay cash from your Wells Fargo account, pay for the vacation, and then pay your banking policy back the interest? I mean, yeah, you could do that too. Any that would be, adding to the paid up additions rider instead of, in bits and pieces over time. Technically, what is that? $140 a year of interest. So yeah, you could send a check for $140 and do that. Maybe have a similar result, but the key is getting more money in the policy. I think that the $5,000 initial dump in is probably the best bet. Another one is, how do you increase your premium? You either start a new policy or you pay more to your paid up additions rider. Only two ways to do it. Start a new policy or add to your paid up additions rider. The more money in your policy and the less money in your bank account, the better you'll be. Remember, banks are parasites. They only exist because we put money there, in which they take all the profit that money produces and they then lend it out to people who don't have money and charge them lots of interest. So what we need to be doing is the only answer to this is Nelson Nash's Becoming Your Own Banker, the infinite banking concept. Get out of that game, profit yourself, stop playing in that world. Go ahead and move as much as you can into your own policy. Stop seeing it as a payment or an expense. Go ahead and see it the way that it's supposed to be seen. Another question, can this be done within the first 5 years since I don't have room in my PUA? Yeah, it can. It just would need to use the money to start a new policy. Yep. If you have cash on the sidelines and you are max funding your policy, then the only way to improve your situation is to start a new policy. All right. We have another one. Does your contribution to your PUA have to be consistent, or can I pay more to it 1 month? Yeah, you can just pay more to it anytime you want. Yep. as long as the policy will fit the premium without creating a modified endowment contract, then yeah, you can really pay to it anytime you want to at random. Now, most policies, obviously, we have scheduled paid up addition rider premiums to go in each month or each year as part of your premium. Just like you can see in this scenario, we had 10,000 a year for 4 years, and then it dropped down. That the difference between the 4,000 and the 10,000 is the paid up addition rider premium. So for a while there, we were scheduling it, but even after the schedules run out, you can still add to it, typically, depending on the life insurance company and their paid up addition rider rules. So, I mean, it's getting into some of the weeds there, but yeah, it does not have to be consistent. You can change it. You can pay more 1 month. Bonnie says, if the PUA was fulfilled in year 5, how did you add money in year 6? Once again, that just depends on the insurance company. Yeah, we only scheduled to pay into the paid up addition rider for 4 years, but we can continue to pay into that for as long as we want to. But that would depend on the insurance company. I know some companies are not quite as flexible as others in accepting paid up addition rider premiums after we finish the schedule. So they don't have as flexible paid up addition rider. We would have to start new policies. Yeah, what do you do? Another person says, because some companies don't have a flexible PUA, what do you do if the money is available but the company won't take it? Well, I keep on going back to the same other answer. If you have money in Wells Fargo that's doing nothing for you and it's only profiting them, and you have policies that cannot accept any more premium, the only solution then is it seems like, okay, we must need more policy because we have more money at our disposal that's profiting other people's banks that I don't want to be profiting other people's banks. I want to profit me. And since I can't fit it into the existing policies paid up addition rider, I must then use this money to help start a new policy. One of the two would be helpful. Another question, how would we find out if we had additional space without mecking if this was to occur in year 4? Yeah, just call us, call Living Wealth here, and we will talk to the insurance company. They run a calculation to figure out how much additional room is available without that you could add in without it creating a mech, and we can send in however much they say is available. Great question. Anyone else? All right. Well, it's been a pleasure as always. Thank you guys so much for taking the time to come out and be with me. It's always a pleasure to speak with you guys. I hope this was helpful. Once again, as we wrap up and close it down, it's always best to use your own policy to fund as many things as you can. But just know that what you really want to do is make sure that as much of your deposit make it into the policy first. Because it's true that if you're sitting around and you're spending money using cash, and you got a lot of cash sitting on the sidelines, and you call me and say, Nate, should I use my policy? Yeah, I'm going to tell you that the problem is that all this money is not, that you're willfully letting a bank make a good living off of you instead of you making a living. We got to move that money out, capitalize your own bank, and then of course we'll use it. So great. Thanks so much for being here, guys. We will see you on the next call. Have a great day.